Thank you, Carl and Sarah. Welcome to the Halftime Report. I am Frank Holland in for the judge, Scott Wapner. Front and center at this hour, navigating the volatility. Are more big swings in store for stocks as geopolitical uncertainty looms large. The investment committee is standing by to break down the setup for your money and much more. Joining me for the hour, we have Joe Terranova, Shannon Sakosha, Jason Snipe, and Steve Weiss. But first, very quick check of the markets. Take a look. We're in the red across the board, as you can see right now. The Dow pulling back almost 500 points. The S&P down just about 0.5%. The Nasdaq pulling back 1/4%. And look at oil. Oil actually up over 5% right now. Crude trading just under $88 a barrel. And really, I think, Joe, that's where we have to start at. We've seen so much volatility in the markets in recent days, a lot of it driven by the price of oil. Oil's up 5% even after a historic release by the IEA. And we're certainly in a headline-driven market. How do you navigate all this?
It's interesting because I think there's two different perspectives on this. If you are in the wealth management industry, you're looking at the environment right now, you're asking yourself, do you believe fundamentally we're at some form of an inflection point that warrants going in and adjusting portfolios? And I think the answer to that is no, based on the evidence. I don't think this is an inflection point. I think this is more of cyclical volatility, more of a cyclical correction. If you are paid on your revenue production, if you are a hedge fund, which Steve knows that world well, if you're institutional, you're focused on alpha generation, this has become a horrible environment to do that. And less is more. And you are participating less. The extreme volatility driven by whether it's a tweet or a headline, that's a very punitive environment to be in. So the people in that world that I speak to, they are providing less liquidity. They are stepping back. They are awaiting some degree of certainty involving the oil market. And then we do have two other headwinds in front of us, one of which is software. We'll talk a little, obviously, about Oracle in a little bit. But the other is the financial sector. And let's remember, the financial sector right now is down most of the 11 major S&P sectors year to date. It's having another awful day once again today. And I think that is also a very significant drag on the major indexes.
Weiss, I mean, he just talked about you and your other peers in the hedge fund community. Is that how you see things? You just want to pump the brakes a little bit right now, hold off on making any moves until the volatility dies down?
Yeah, look, return is defined by your point of entry. And right now, we don't know if the point of entry is the right point of entry. Now, if you take a very long-term view and you say, you know what, so-and-so stock has gotten cheap enough for me, I'm going in, and if it falls another 10%, who cares, right? You're taking a long-term view. But look, markets are hard to predict normally. And predicting all the crosswinds, tailwinds and headwinds, how they're going to fall into place, and if they come into existence, is virtually impossible now. So for me, it's pretty much, staying where I am, and I've got a quality portfolio, staying there. If something gets ridiculously inexpensive, like a Netflix or Microsoft, I've added recently, or Alibaba, which, apologies to the producers, I added to yesterday, then that's fine, because I know what the long-term story is for them, regardless of market and volatility in the market. So my advice is, don't get upset about the volatility. Don't try to trade this volatility, because that's really a sucker's bet here. The best people I know aren't willing to trade it, and I think just hold what you have. Don't panic out. That's always the worst thing to do. And we'll just see how it turns out. Nobody knows. What the critical impact's going to be, in my view, is not only how long oil stays elevated, and I'm not surprised to your point that it's not responding to, to the massive, release of the reserves, because that's been well advertised. If they didn't release it, then you've seen something else in the market. But we're also going to hear more job cuts, substantial job cuts from AI. And to me, that's a short-term positive, but a interim, medium-term negative. So I would stay away from consumer discretionary stocks.
All right, you mentioned two interesting points. Number one, the uncertainty, and also the entry point. Shannon, I want to come over to you. Bank of America actually out with a note about this earlier today, saying in part, policy uncertainty is the highest since 2025 Liberation Day. We all remember that about a year ago. And history shows that extreme uncertainty has often marked good entry points for long-term investors. Now, everybody in this market is not a long-term investor. What do you think about this volatility near term? And if you are a long-term investor, where do you put money at right now with the thoughts that things are going to rebound and settle down?
Well, we are certainly long-term investors, and so I think one of the challenges here is balancing out, to your point, what our views were coming into this year in terms of what we felt would outperform and what was kind of relatively well situated, with the acknowledgement that we expected there to be some additional volatility, particularly on the policy side. So if you're in an environment where you expect there to be dispersion, our view was that the underlying economic momentum and the fundamental aspects of things like the transmission of the OBBBA, kind of tax relief coming through, lower interest rates, improved sentiment, and potentially an uptick in M&A activity, all of that pointed us towards what we felt was a basket of quality stocks, not just here in the United States, not just large cap, small and mid cap stocks. Ex-US developed, emerging markets who, frankly, for many of those economies have hit the inflation challenge head on and have a really nice balance sheet and current accounts. So our view is that in this environment, all of those things can continue to be allocated to in alignment with your allocation that you started the year with. I think tactically, you're also starting to see signs that there may have been some overselling in some of the areas that, perhaps we were not as constructive on coming into this year. So technology, for instance, you've seen a meaningful re-rating. But most importantly, I think the dispersion, the divergence, the differentiation between names that we anticipated this year has really come to the fore. On the fixed income side, Frank, we don't talk a lot about that here. But there's actually some opportunities in duration right now. I think we're all focused on credit and credit quality. You look at what's happening in the high-grade bond market, the issuance this week, you're looking at the potential for further curve steepening, especially if we move past the Middle East conflict. So I think kind of reiterating where you stood at the beginning of the year, looking at the underpinning of that thesis, and then taking these opportunities as they're being presented to you is critical if you're looking past the next 6, 8, 12 weeks.
All right. Jason, we'll come over to you. Joe mentioned the wealth management business. That's the business that you're in as well. What are you telling clients right now? I'm sure some people want to take some chips off the table, I would imagine, because some parts of their portfolio have been under pressure. Where are you seeing the opportunities? Where are you seeing areas that you think might be seeing long-term damage?
Yeah, no, I think it's a little bit of the play that's already been moving so far this year, which is obviously the infrastructure, AI beneficiary stories, the Eatons, the GE Venovas, the Cornings of the world. I think those stories still remain intact. I think the other opportunity is, to Shannon's point, what's going on with tech. The hyperscalers obviously haven't meaningfully participated so far this year, and I think you always, in geopolitical events like we've experienced, there will always be dislocations, and you always got to do a pulse check on where we are in the cycle. So I do think, the hyperscalers are an opportunity. That's another place where we're looking at. And I think software now trading at 16 times forward, which is below a market multiple. I think there will be opportunities there as well, because I think there's a harmonious play with AI and software on demand. We'll see how this story continues to play out, but I think those are few of the areas where there's opportunity.
Yeah, a number of recent notes saying this is an attractive entry point for software, one of those areas that a lot of people seem to be putting some money in. I think we have to go back to oil. I'm looking at oil right now, up about 4.5%, almost 5% right now. And I said this on Closing Bell the other day. We keep having people come on, whether reporters or traders like yourself, saying ever. Biggest release from the strategic reserve ever or since. WTI had one of the biggest price moves yesterday since 2022. Joe, you made some moves in the oil space. How do you play oil here, or should you even try with so much questions going on about the Middle East? And I just want to point this out in my world. Maersk reporting an issue in Oman just a short time ago, about an hour ago, saying that they're shutting down operations there. So we continue to see issues outside just the oil market with this conflict.
So you had to, I think, get in front of it in terms of energy allocations. In the fourth quarter, it was very clear, to Jason's point, the market was making a shift away from high beta, a shift away from momentum towards quality, towards defensive. Healthcare, leading sector. Energy began to make its move in the fourth quarter. So in front of that, refiners were clearly some of the energy names that you wanted to own. I own Valero, I own Phillips 66, I own Marathon. Till this day, I still own Valero. I think you maintain exposure there. In addition to that, I have EQT. So I think you had to be kind of in front of it. If you're now in the moment and you're trying to race to catch it, you're not going to. Right. Because it's the equivalent of the Rocky movie where he's chasing the chicken trying to catch it. You're just not going to catch it. And if you think about what's gone on here with the actual spot oil market, I gave some statistics the other day. I said at the end of February, the average volume for spot crude oil was somewhere around 300,000 contracts per day. We had bumped that up to 1 million once we had the conflict that began with Iran. Now what we're seeing is that figure's coming down once again. And what that's telling me is that professional oil traders are doing exactly what I'm suggesting, what I'm advocating for. They're stepping back and they're saying, wait a second. These headlines, they're just dizzying. The tweets, they're dizzying. I can't get in front of, I can't profit from a headline or from a tweet. And I think a lot of people are basically stepping back. So I don't think you're chasing it here. I think if you were fortunate enough to have the energy exposure coming into it, you maintain it. But certainly I think at this point, oil could go up or down 10 or 15% on the next headline or tweet.
You know, when you said the Rocky reference, I thought you were going to go Adrian yelling at Rocky that you can't win when he was supposed to fight Mr. T, because it's kind of hard to win with this oil trade right now. Shane, I want to come over to you. There's another side of this position. Piper out with a note saying, in part, not your 1990s oil shock. They go on to say, in fact, unless prices for oil are above $100 for a sustained period, many months, the impacts to core inflation and GDP are likely to be surprisingly modest. Now, that's the economy, not the market. Do you agree with that take that perhaps some of the reaction to this may be overdone? And unless this lasts many months, which it could, nobody knows, and why she's been great pointing that out. We don't really know. We don't know what's happening over there, that this isn't as big of a deal as it seems to be.
I think what you have to really differentiate between is it the energy price movements and how they're impacting today's kind of discretionary and non-discretionary basket for the U.S. consumer? Or is it a longer-term period where higher oil prices transmit through a number of different industries and then become a pass-through to the consumer? And I think that requires a significant amount of time in terms of the duration of this oil shock. It's also important that we understand that, you know, the part of the rationale for the U.S. perhaps holding up a little bit better from a market perspective than what we're seeing for our colleagues in Europe, for instance, is that we have access to more diversified production from an energy perspective today than we did 30 years ago, or whatever point in time you want to reference. And so we are not insulated from these moves in gas and oil prices, but I think that we're better insulated than our compatriots over in Europe, for instance, and to some extent certain economies in Asia. So I think that is an important piece, is the duration is not just about how long the U.S. consumer or U.S. businesses can digest higher energy prices in the here and now. It's having to then factor those in to end prices along the supply chain, which, as we know, is much less transitory and has the threat of being more structural.
Yeah, I think the issue is, to your point exactly, is that, look, there are certain businesses that have a fuel surcharge, and that may be freight. But when you click on Amazon, you're a Prime member, free delivery in 2 days, somebody's paying that surcharge, right? Yeah. And ultimately, it's going to be the consumer. First, it's going to be the company. Now, when you raise prices because energy prices are going up, I don't think we ever really see those prices come out if it's not as a surcharge. So the longer-term effects of inflation are going to exceed the time frame of the war and the destabilization in the energy markets. So that's what you have to be careful of. Then the reason why I wouldn't touch consumer discretionary, I wouldn't touch retail here, is because 2/3 of the country lives paycheck to paycheck. And they're already making decisions, unfortunately. What do I not buy so I can put food on the table, where we've seen prices go up? I've got to use my car to get to work. I'm worried about my job. So what's that all come down to? It comes down to less shopping at the Gap, less shopping picket, right? Mm-hmm. So those are the issues, and those issues aren't going to go away when you have a president whose approval ratings are so low, and the general consensus on his handling of the economy is so low. There's a fear factor out there. So that informs consumer spending habits of the 2/3 of the economy that really matter. And that's where I'm concerned. Throw in the AI job losses, and I think you've got a major problem.
But don't you think there are some opportunities being created in areas like fast casual, in areas like travel, which, frankly, TSA throughput has been continues to rise, actually, over the course of the last couple of months. So I don't disagree with you, Steve, on that. I just think one of the things is to really look at, again, is that dispersion and try to price in, what is that additional impact that we could see if we're only looking at a 2 or 3 week duration from here on out.
Except, for dining, like fast casual dining and travel, they've been holding up pretty well. And because the airlines, let's face it, they're all monopolies in markets. So they own the pricing, and their bookings generally are pretty far out, where they were booked before the fuel surcharges and all that. So somebody's going to suffer hits of margins, but I guarantee they're going to make it up.
But if you look at ticket prices right now, I think you're going to see some of the impact of those higher costs. Those people got a discount.
It was already insane.
Well, compared to what it is now, if you bought a few weeks ago, that was a discount. Jason, I want to come over to you. I want to go away from the economy for a minute and come back to the markets. Does this rise in oil prices? We're looking at the Dow today, showing it just now down about 1%. Does this change the broadening of the market? Does this change the attractiveness of the halo trade? I believe that was Kristen right here, or another trade that actually came from Bernstein, Dave Vernon, great transportation analyst, the iron trade, infrastructure, real assets, optimizable network effects. That's another acronym that he's put out there. But the idea of these real economy trades, does it change that narrative?
I think in the short run, absolutely it does. And I think, to everyone's point, it's about the duration on how long this actually lasts. If I think about the strait, 120 ships pass through that strait every day in a normal environment. There's no movement. I think that's possibly why, yes, I think this release today, this significant release, is baked into the market, but it takes a lot of time to get these ships moving again. This is a weeks and weeks story. So I think the longer we continue to deal with this, the more impact it will have. I think, to Steve's point again, 70% of GDP is consumer spending. The disproportionate wallet share, 50% increases payment at the pump, hurts these folks and how they kind of change what they're doing from a consumer and discretionary spending perspective. I think as we look at transports as well, the FedExes, the UPSs of the world, they obviously have pulled back. I think the Amazon point is well taken, but I think it's all about duration, how long this continues to play through, and I think we need to get movement. Everyone knows that, but that's the real story here for me.
I think the consensus expectation is that $90 oil is not going to be the price as we move towards the fourth quarter of 2026, and that's why I said this isn't an inflection point if you're in the wealth management industry where you're thinking about making significant portfolio reallocations. I think where you lose comfort in the economy is if, in fact, yields were to begin to spike. And now, look, we're up 5 basis points today. The 10-year's at 4.21. That's not overwhelmingly troubling, but it's going in the wrong direction. I don't think the market likes it very much, and it shouldn't like it very much. To me, that's more of a concern when you think about going forward into 2026. Rising oil prices, I think there's a remedy for that. Rising interest rates, that's a little bit harder.
Yeah. Just to put a button on this, and to your point, Jason, actually, Maersk came out today. They say they have 100 container ships stuck in the Middle East, and they say it take about a week to 10 days to get things, quote unquote, back to normal as we all adjust to this new normal. I want to switch gears now to one of the bright spots in the market today, and of course, that's Oracle. Take a look at this chart right now. Oracle shares up almost double digits right now after earnings. I think the question is here with Oracle, this has been a very volatile stock. It's fallen well off of its highs just a couple of months ago. A lot of questions, and Jason, I see you nodding here. Are all the questions answered? Are all the questions answered when it comes to Oracle? And is this just about Oracle? Because we've also talked a lot about Oracle being the public proxy for OpenAI. OpenAI making some deals and some controversial statements in recent days and weeks as well. So is this just about Oracle, or is it a read on something else?
Well, let me just speak to the print. I think the print was obviously a phenomenal print. I remember we were here several months ago talking about the RPO numbers, right, north of $500 billion. But
those
I think
came under question, right? Almost
no
after
doubt
we had
about
the
it, in
conversation.
terms of execution,
right?
But this is the first quarter in 15 years that we've seen double-digit, 20+% EPS and organic growth return for the quarter. So I think that was a big story. I think the other story is reaffirming the guide in terms of CapEx, which is a $50 billion number, and I know these are major dollars, but when you, on a relative basis, compared to the other hyperscalers, they did not raise CapEx. So I think that was a big story for the print. And then when you talk about this 10 gigawatt data center build out, they are moving forward with the strategy where there are folks that are prepaying and bringing GPUs to the table. And I think that is also an important story as you look at what has been the chinks in the armor: negative cash flow, negative free cash flow. I mean, I think that's been the big story. So I like this print. Let's see where the momentum takes us going forward.
All right, Jason, you're a shareholder. Joe, you own this one in the Joe T ETF as well.
Yeah, I believe it advances the premise of stability. And I think in beginning of early February, you were questioning that. Around February 5th, you reached a low somewhere around $135, $136. You've stabilized price since then. What this report does is it gives you a degree of confidence that there actually is the cloud computing execution that allows them to go forward with that $50 billion in capex, which they've talked about. OCI, the Oracle Cloud Infrastructure, coming in with a really strong number, up 68% quarter on quarter. That's better than expectations on a year-on-year basis, coming in above the consensus at 79 at 84%. Again, that's a really strong quarter. So is it blue skies? No, and it shouldn't be blue skies because there's real questions as you look forward into the future. But I do think this conglomerate has seen some of the massive storm clouds that were present at the end of January into the early days of February dissipate.
Yeah. So, Shin, I want to come to you. I know you don't own Oracle, and I know you're not a tech analyst, but I want to go back to that RPO number. And Dan Ives came out with a note saying the story just remains all about their backlog, which is RPO minus OpenAI. I'm looking at this number, $553 billion, quadrupling year over year. Now, is this a bellwether of what's going on in tech in general? Can we look at it that way, or is this a single stock story with tie-ups to some big private companies?
So I think the challenge here is that we came into this year and we were battling this tension between oversupply and then obsolescence. And now I think, frankly, the conflict in the Middle East has allowed investors to take a step back and understand that the story is somewhere in the middle. I think that there's no doubt that if you look at, especially the scrutiny that Oracle has been under over the last year or so, that it's incredibly important for them to come out and allay the fears in terms of, most importantly, the debt that they've taken on to be able to service and build this backlog, right? So I think the challenge is here is that with each of these announcements, you get a more and more nuanced story, and that's incredibly important for this market because there's questions about the monetization, there's questions about the duration and the timeline of when these investments are going to pay. But I think more importantly, I think people have had a few weeks to take a step back, maybe put the pot in the, on the back burner, on the simmer, and have time to look at the fundamentals. And so I do think it's important not only from an equity perspective, but perhaps even more so from the credit perspective, where we have seen a lot of pressure on tech.
It really isn't lifting, though, the software industry today. When you look at it, the IGV is still down. You have Salesforce down. You have Adobe down, the names that we own in the ETF, Palantir, Zoom, Cadence, they're all down as well. So it's not like there's this universal feel-good story surrounding software today because of what we heard from Oracle, which I think some would have expected.
But that's don't you think that's because it's somewhat idiosyncratic in terms of that story with Oracle over the last year or so?
And also, in all fairness, Salesforce is actually down on a downgrade from Moody's as well, which may be dragging the sector today because sentiment's been pretty high. And we have a lot of notes. D.A. Davidson saying for the first time in 5 years it's investable on Monday. Deutsche yesterday upgrading tech to overweight. I mean, Weiss, I don't want to leave you out of this conversation. How are you looking at software right now? Are you looking for opportunities, whether at an ETF level, sector level, or maybe a single stock level?
For me, it's Microsoft. Look, I think software is going to be very challenged. I mean, when you can write code without ever having learned how to write code, that's problematic for software companies. And that's Salesforce, and that's Adobe for sure. It's all the others. I mean, look, it's people want to say, well, that's ridiculous. Can't get rid of Adobe. It's not so ridiculous. We've seen plenty of companies that were the company in that space that are far less relevant today than they were before. And that's an Intel, that's an IBM, the list is legion. So we just don't know. So you go to the one that was earlier in AI that has other major revenue streams and that is an innovator, and to me that's Microsoft. That's the only place I'm really willing to bet. I see no reason to go to Salesforce because when you talk about CRM, that's easy to replicate. Now, I'm not saying it's easy, anybody can do it, but I'm saying if you're a company and you take a look at the IT budgets and I've heard them talk about it at JP Morgan, at BlackRock, at others. Those are massive budgets. I mean, take a look at what their license fees are to a Salesforce and to others. They're highly motivated to create that product internally for their uses, and that's exactly what they're doing, and we've seen them do it already. You know, in terms of being able to get rid of analysts, for example, investment banking, because it's automated. And we look at companies all the time for our analysts do the same thing. So I just think it's treacherous, catching a falling knife. You can look at what the mistake people make is that they say, well, the valuation historically was 25 times EBITDA, and now it's 15 times EBITDA, so that's on sale, that's a buy. But the fundamentals have changed, so the old valuation metric just doesn't apply. Maybe it will, but nobody has the vision to know if it does or doesn't.
Yeah, a lot of uncertainty out there. And to Joe's point, the IGV down over 0.5%, falling more than the broader market. Speaking of the issues for software. All right, coming up next, Jason, I want to come over to you. Here on the desk, you have ownership in the private credit space with Apollo and Blackstone. Yeah. What do you make of this report?
Yeah, so I mean, obviously, this storm has been very difficult so far this year. I mean, essentially all the alt managers are down 30%. I think as it relates to Apollo, for me, you know, I think about their insurance business, Athene, which I think insulates them to a certain degree from all the mess that's going on. I'll also add their retail BDC, you know, as we talk about the software story and what's going on there. They only have 2% exposure, and they've also guided to 20% growth in fee-related earnings. So, you know, it has been a difficult trade so far this year, but I continue to like this one. Blackstone, you know, another one obviously is down 30 so far this year. They deployed over $138 billion in 2025, and I think the realization environment will continue to improve. So I have kind of been patient in staying steady with these names here.
I want to pivot over to financials and with you, Joe, really quick. PIMCO actually blaming what they call sloppy underwriting for some of this private credit reckoning, saying it's not just a crisis of confidence, it's a crisis of really bad underwriting. Does this make you concerned at all about the broader financial space?
Well, first of all, the financials coming into the year as it relates to positioning and sentiment, overwhelmingly you had bullishness, and that bullishness was expressed in overweight positioning. So that's the first thing to understand. The strength right now in financials is in the exchanges, CME, IBKR, and a lot of the insurance companies, Travelers, Chubb. Here's the challenge in front of us. We have right now lending to software companies where we don't have the visibility and the transparency on what price discovery ultimately is for the value of the loans. We have something in front of us that can be very constructive if, in fact, the Federal Reserve actually does their job. The Federal Reserve raising, lowering rates, yeah, we all understand that. But if Steve Leisman's watching, you want the question asked of the Federal Reserve chairman at that meeting during the press conference. What is the communication line right now with Wall Street lenders? Do they have the transparency on the true value of these loans? Can they give the marketplace a degree of comfort that they are on top of the situation? We need the Federal Reserve to get in front of this situation and to let the marketplace know, in fact, where they believe the real valuation on this lending ultimately.
Let me give you a very, very short primer on private credit. Private credit, they raise funds, capital, and then they're forced to put that to work. They're not raising capital for lending and substandard lending in cases, you know, to hold it and pay, you know, whatever, a money market rate on it. So their job is purely raise the capital, put it to work. Now, it's become very competitive finding great credits. So what are they going to do? They're driven by fees. So they want the fees on lending. They don't get fees if you're just in cash management. So that's the whole game. Now, you don't have the same regulatory oversight. So you don't have the same reserve requirements and all that. So it's the shadow lending system that we were all concerned about that really grew exponentially and that we were all concerned about. Now, I wouldn't worry so much about the BlackRocks. I wouldn't worry about the Blackstones. I'd worry about the second and third tier players because they're the ones that didn't spend on the risk controls and the underwriting management. If I own those like you do, I wouldn't be a seller. I want to buy them because they're cheap, but I don't see any catalyst right now, and maybe not for this next 6 months or a year, depending upon if we go in recession or not, like we did from the oil shock in the 70s, where it just doesn't make sense to load up on these now. I'd rather miss the first 10% up than catch the next 20% down.
Understood.
Hey guys, welcome to Blue Cloud Trading. I'm George. It's Wednesday. It's March 11th and it's 4:51 p.m. The market has closed, and now we can do a quick analysis and see what happened with the stocks that they talked about on today's halftime report. We're going to go through that list. There's quite a few. There's let's see, about 26 stocks and ETFs. I already previewed these. I've done the analysis. That way, we get a better understanding about what they are recommending. Some of these stocks they're recommending, some of them they might have closed out of, but we're gonna look at the charts, and we're gonna use the Ichimoku indicator. We're gonna look at the S&P 500, the Nasdaq ETF, the QQQ, the Dow, the Russell 2000, the VIX. We're gonna look at the Mag 7 stocks today, and we also have 3 stocks from our members that we will take a look at as well. We're going to do all that in a very short period of time. We don't need to spend too much time because we're using this fantastic indicator. It's called Ichimoku, guys. Ichimoku. It can make your trading a hell of a lot easier, and you'll have a better understanding of where the market is currently and where it's been in the past, so that you can get a better understanding. And you can see this little turnover that's happening here in the S&P 500, for example, right? You can see that the S&P 500 is weaker today than it was back here in January. Okay. So that's the thing that you have to keep in mind, that we are we're moving downwards right now in the S&P 500. You can see the ADX is moving up. That represents the momentum is increasing to the downside. The negative DI9 is moving up. The positive DI9 is moving down. So this is bearish. Okay. So that's one of the indicators that I use. And we'll also be using the Ichimoku indicator that you see right here. And let me show you the monthly chart. The monthly chart still looks very bullish for the S&P 500. I mean, it just, you can see here 2 months now that we've been pulling back, right? But the war in Iran could be the catalyst that breaks through the Tenkan-sen. It's possible if things start to deteriorate, oil prices continue to move up, stocks continue to drop. So right now things are not looking particularly bullish, even on the monthly chart. I'm not like super bullish here because of the candle that's forming. The prior candle here, we had a reversal candle last month during the month of February. Okay, that's a red spinning top. If you're unfamiliar with this candle, just take a look right here. Let's take a look at x.com. This is my channel on X. It's called Blue Cloud Traders, where you'll find me, Blue Cloud Trading. If you scroll through to highlights right here, okay, the tab, go down a little bit, go down a bit right here to the candle pattern reference sheet, and I'll show you this bearish spinning top candle. It's a single candle pattern. When you see one of these after a move up, that's very bearish. If you see it on a monthly chart, especially, we should be more concerned, because look, it did lead to a pullback this month so far. The market has been pulling back. Here's the weekly chart, okay, and here's the daily chart, and here's the 4-hour under the Ichimoku cloud. So we've been declining here. Very easy to see this decline on the 2-hour, right? A series of lower highs and lower lows on the 2-hour time frame for the SPY. So we're not in bullish territory at this point, at this particular moment, with the index ETFs I'm going to go over in a few seconds. So let's take a look at and see what happened today. Specifically, the Dow Jones, okay, was down 0.61%. You can see it dropped some more. It basically stayed, under the prior day's closing price. The Nasdaq, it actually gapped up in the morning, dropped under the prior day's close, came back up, dropped again. It was only up 0.08%, very flat. S&P 500 was down just 0.08%. The Russell 2000 was down 0.20%. I sort of predicted yesterday that the stocks wouldn't do so well today, and they didn't. And that's because of what occurred yesterday when they talked about the mines in this particular Strait of Hormuz in the Persian Gulf, where the typically the ships have to come through here, right? In fact, today there's a new article that just came out. Iran attacks at least one ship in the Strait of Hormuz, a key oil passage. 3 vessels were hit in and around Persian Gulf on Wednesday, according to a British maritime agency. Now we need to get our information from other countries, folks. Iran claimed responsibility for one. At least 3 ships were hit on Wednesday in and around the vital oil route of the Strait of Hormuz. That's kind of interesting that they did in fact claim responsibility for one of those. So what does that mean? Who hit the other two? Um, that's interesting, isn't it? I don't know. That's kind of like we maybe we should do a little more investigation into that. Um, it'd be interesting if we found out that it was like friendly fire. That would not be good. That always happens typically in wars. Um, if you go back in time and you look through our history. So let's look here. A Japanese container vessel owned by Mitsui, a large global shipping line, was among those hit, according to PLUR, Global Ship Tracking Company. The other targeted ships, according to PLUR, were bulk carriers or vessels designed to transport loose cargo like grain or iron ore. This increasingly points to a sustained pattern rather than isolated incidents. And so yeah, very interesting. This is not going to be good for the markets, obviously going into the future. And because guess what? Even if the United States decides that we want to stop this, Iran has to also, right? And they are not ready based on the news that I'm reading. Let's take a look at the heat map. Here's the heat map. You've got basically the consumer defensive stocks were down mostly here. Industrials were mixed. The energy stocks were very green today. A lot of the technology stocks actually did well. Like Nvidia was up just 0.68, Micron was up, Intel was up, Tesla was up 2.15, Google was up slightly there. If you look at the 1 week performance, let's take a look at that real quick here. It's mostly a lot more red, right? The semiconductor stocks have done pretty well. Some of them, like Broadcom, is up 7.57. Let's look at the 1 month performance though. Ooh, not so great. Utilities, a defensive sector, energy, okay, industrials and mixed mostly. All right. So let's and crypto, by the way, was up 5.41. Look at Bitcoin up to 70,562 today. And ETH is up 5.31. I'm using FinViz Elite, folks. This is a great software website, or a website that does pretty much everything that you probably could use for analyzing stocks. So for example, you can get news, all right, and they're all updated by the time. You can set it up so that it's by time or by source. Maybe you want to just look at the Bloomberg or Wall Street Journal or Reuters or CNBC, whatever. You can look at those by the source itself. And there's a lot of other great things. And if you use the FinViz Elite, you can also add the charts like the Ichimoku indicator, for example. So if I look at the S&P 500 here, the SPY, there's the Ichimoku. You can do that with FinViz Elite. You'll get more information. You'll also get the fundamentals down below. So that actually, let me throw on a company like IBM, for example. It's going to give us some more information. So there's the chart at the top. You'll see like earnings announcements. See that little E right there? It tells you, the earnings date, what the report was. Down below here, you can find out a little bit more about the company. Maybe you want to know how many employees there are. Well, there's 286,800 employees at IBM. Maybe you want to know about the average volume traded, 5.58 million shares traded on average. How's the company done year to date? It's down 15.98%. Okay. Maybe you want to check out their sales, year after year. You can scroll down to find about most recent analyst ratings, news just for that specific stock, right? So it's going to talk about IBM in any of these articles here. Scroll down further, a little bit of a synopsis of the company, institutional ownership, right, of different managers or funds. So then you can look at those funds individually. I mean, there's so much. And there's also of course, the income statement, balance sheet, cash flow, all that stuff is right here. It's one of the critical websites that I use. It's one of the most important websites that I use. I use this, and I also, of course, use TC2000 for a little bit more in-depth chart analysis, as you know. And if you guys want to use this as well, the FinViz Elite, make sure to go to x.com, my X page here, at Blue Cloud Trader. Okay, that's my handle. Scroll down. I just put a new ad here. You can, by the way, they have a free version of FinViz, so you can use that for free. The only problem is the information is 15 minutes delayed that you're getting on the charts. Okay, you also won't be able to put on the Ichimoku indicator like you see right here on the free version. And if you do want to use this, make sure you use this affiliate link here. It would be helping to support Blue Cloud Trading. All right, let's get into the index ETFs here, and I'm going to give you guys a quick little synopsis of the. I'm going to show you guys the monthly chart here for SPY, which, by the way, is still relatively bullish, even though we've been pulling back these last couple of weeks. And I'm sorry, couple of months. We're looking at a monthly chart here. We're right at the Tenkan on the monthly. But the reason I'm using this time frame is because it's a little bit clearer for you guys to see the chart. And yeah, I'm just going to explain it to you very quickly. So Ichimoku indicator is a Japanese indicator that is used by many financial institutions. It was published in the late 1960s in Japan, and it's a fantastic indicator because it shows you the strength of the trend. It also shows you when there's weakness in the actual trend as well, as you'll see in those shorter time frames. Here's price above the green line, the red line. Now, the green line is the Tenkan. It's the midpoint of the last 9 periods. The red line is the Kijun. That's the midpoint of the last 26 periods or 26 months. And we want that green line above the red line because that's the faster moving average above the slower one. Now, the cloud itself is derived by taking the midpoint of those two moving averages. So if you go right in the center there, and you project that 26 periods into the future, that's where the Senko span A is. Okay? That's the first part of the cloud. And then Senko span B, this purple line here, is the midpoint of the last 52 periods. And when I say 52 periods, it's because we're looking at on a chart. It could be monthly, it could be weekly, it could be daily, depends on what time frame you're looking at. In this case, it's the last 52 months. And instead of projecting it under the candle or above it, it's projected into the future, 26 periods in the future. So 26 periods into the future is the Senko span B. That's what comprises the cloud. When the Senko span A is above the Senko span B, that's bullish. Okay. When it's moving up like this, and the thicker the cloud, the stronger the trend. Back here, where it was weak, it was kind of like thinning out. You can see the pullback that we had right there. I mean, the S&P 500 historically, obviously, the majority of the time that in its existence has done quite well. If you go back to 2008 over here, you can see where it was under the cloud for multiple years, right? And it took quite a while for price to recover. From 2008, for example, see this level here, you'd have to go straight out into 2013. So all of this whole time span here, your money was trapped in the S&P 500 and wasn't basically, I mean, if you had bought here hypothetically and you were waiting for the S&P 500 to give you some bullish results, you'd have to wait until 2014 literally before things started to move back above those levels. Of course, if you bought down here, then you would have been very lucky because that's the bottom of the 2000. It was around 2009, and since then the S&P 500 has been up 865% or so, right? So monthly chart, here's the weekly chart. It's going to be a little bit, you can have more volatility. You're going to see more potential breakdowns under the cloud like back in 2022, right? If you switch it to a daily chart, same situation, right? Back here in 2025, remember March 3rd, 2025, the market dropped. When it got into the cloud, it dropped approximately 17% or so in just 1 month. So it just helps you to assess the strength of the trend that we're currently in. And right now, we're in a weak trend. We're in a weak trend because the cloud is identifying exactly what's happening here. Prices inside the Ichimoku cloud, okay, on the S&P 500 on the daily chart. This is no man's land, basically. We've been basically consolidating here for quite a while. You can see since literally November, December, January, February, we haven't really moved much. And now, okay, we're actually in a more of a downward trend, to be honest with you. Do you see this? That's a lower high right there, okay, from the prior one, right? You could call that maybe I don't know, you can call it a triple top, maybe, right there. Um, we declined and we broke through these lows, all right? So, and now we have a lower high here, so we're basically in a decline, essentially. Now, the directional movement index also confirms this. Again, we're looking at a daily chart. So that's why I'm not suggesting that people at this particular moment be ultra bullish in the market with the S&P 500 buying the SPY. This is a stock picker's market. Within this group of stocks, there are very strong stocks and there's a lot of weak ones too right now. There's more weak than strong. So we have to be very selective. And that's where the analysis comes into play. And that's what we're going to, that's what I go over each weekend when I do a members only video. If you guys want to get access to those videos, just go to my page here, Blue Cloud Trading, click on the join button, and you can access those member only videos that I post every weekend. I go over my entire portfolio and I give 30 new stock ideas based on the technicals. All right. So let's look at the SPY. SPY is inside the cloud on the daily chart. Nothing to do here. Okay. We've got a bearish cloud too, by the way, on the daily chart. When I say bearish, that's when the Senko span A crosses onto the Senko span B. Okay. Technically, we still are above that 200-day moving average. Okay. But we've been declining. What about the QQQ ETF on the daily chart? Because we're looking at dailies right now. It is currently under the Ichimoku cloud, also bearish. Also, you can see that series of lower highs here, right? Not looking good for the Qs. How about the Dow Jones? How does that look? Also bearish. Okay. On the daily chart, folks, on the daily chart, we have a lower high here from the prior one. Okay. And so there's weakness here. There's obviously weakness, and the ADX is still moving up with the directional movement index. And that represents momentum, like I said earlier. When that's moving up and the negative DI is moving up and the positive DI is moving down, that's very bearish. Down 0.6% today. What about the Russell 2000? Well, this one, is inside the cloud, so there's nothing to do here. Oh, I forgot to mention one last indicator or one last element of the Ichimoku, and that's the Chiku span. That's the lagging line that you see right there. What that essentially is the current price right here projected 26 periods into the past in a line form. And the idea is to see where that white line is in relation to the candle 26 periods ago. If it's underneath it, that's bearish. Okay. When it's above, like it was back here, it's bullish. So Russell 2000 not looking particularly strong here, obviously down 0.2% today. The VIX, interestingly enough, actually dropped 2.45%. Okay. So it did drop a little bit. Okay. Interesting. But it's still in an elevated level of 24.23, where back over here we were like, in the 13s back in January for, between 13 and like 17. This represents volatility in the market. So obviously when you're at war, you're going to see this spiking. In fact, back on Monday, March 9th, it went up to a level of around 35, big spike before retreating. FEZ was actually up. The Eurostox 50 was up 0.08%, the only one of the ETFs here. But the problem with this one too is that currently it's under the Ichimoku cloud, so that's a bearish place for a price to be. Wouldn't be recommending this here because the cloud is also turning bearish as well. We did find some support at the 200, and that's great. But right now the evidence is to the downside, continued decline. All countries are going to be affected by this war. Let's look at the Mag 7s now. Apple, inside the Ichimoku cloud. Same situation, nothing to do here. We have a lower high here. Okay. Amazon down 0.78% under the Ichimoku cloud, into the 200. No on that one, even though it's been moving up slightly recently. It's nothing particularly exciting. Google, still under the cloud as well, even though it was up 0.54%. Meta, under the cloud, up 0.12%, nothing special. Microsoft, same thing. We've been under the cloud since this point right here, back in November. It's actually dropped 20%. So you can see that, obviously this can be very helpful in keeping you out of stocks and tying up your money in something that is obviously in a decline. Wait for it. Wait for the pop above the cloud, like over here, for example. And you can see how that led to a nice move to those highs of approximately 29% in about 3 months before, of course, dropping. And it's important to also use candle analysis as well. That's why I look at the candlesticks to help me get a better perspective about what's happening. Let's look at Netflix. That one, so interesting how how respected the cloud is as far as where price finds resistance at the cloud, because there are the traders out there that are watching this exact same indicator, folks. And guess what? It's stalling now, right? It found resistance there, dropped some more. And it's not just traders, it's financial institutions too. So right now, price just dropped and closed under the Tenkinson, down 2.13% for Netflix. I'd stay out of that one. Nvidia, when I say stay out, what I'm essentially saying is don't be buying the stock here. It's just not, it's obviously turning over, right? Wait for more evidence that this thing is turning to the upside. And it, by the way, I wouldn't just rely 100% on the daily chart. Personally, when I'm doing my analysis each weekend, I'm looking for stocks that are strong on both the weekly, and this, by the way, is not strong on the weekly because it's under the cloud on the weekly chart, and above the chart on the daily, because when price gets above that weekly chart on with the Ichimoku indicator, I'll tell you, it can last quite a while. Measuring from this point right here to that high on the weekly, that was a 2-year run, where Netflix moved up about 208%. Okay, once it got under the Tenkinson right there, if you measure to the low here, and that did move up briefly above the moving averages a couple of times, but um, you know, you could have gotten out for a much smaller, like, you know, loss if you decided to like enter and then get out. But basically, from that point right there, if you measure to these lows, it's a 37% drop in approximately 7 months. So Netflix hasn't really been that great. We did have a big spike here with the earnings announcement during the week of February 27th, right? Friday, February 27th. And now it's stalling, which is 100% normal. When it comes up to the Kijinsen and the bottom of the cloud, expect that. So down 2.13%, not something I'd be touching. Nvidia, stagnant. I'd call it just stagnant. Not a whole lot going on here either. Now the Chiku span is still above price, which is good, but the green line crossed under the red line. That's bearish. And price has been consolidating, meaning it's just been moving sideways right there. So there's nothing to do here with Nvidia either. On the weekly chart and on the daily chart, you can see it even more clearly. Tesla, onto the cloud, nothing to do. It was up 2.15%. Okay, let's get into the stocks now that they talked about on today's halftime report. Again, this was from today, March 11th, earlier in the day. I've already reviewed these stocks. I can tell you that the top ones here, these top 5 ETFs that you see here in stocks, a mixture of those are the strongest ones. The rest, there's something off technically on either the daily or the weekly chart. So we're really looking at just 5 out of 26. I mean, I'll show you guys these charts, but I'm just telling you that I'd strongly uh, recommend that you stay out of those for the time being. But to each their own. EQT Corporation Oil and Gas, of course, that's going to do well. Look at it. Here it is on the weekly chart. What did it do? It broke above this level, the 62.23, this prior high from December 5th, 2025. Okay, that's very bullish, up 3.23%. Look at the directional movement index. Remember what I said earlier about we don't want the red line to be above the green line. And in this case, the green line's above, right? So that's the dominant trend is up. When the green line, positive DI, is above the negative DI. And when the ADX is moving up, that means that the momentum is increasing to the upside. That's very bullish. So EQT I like Oil K. This is the ProShares K1 free crude oil strategy ETF. And up 2.92%. This is the weekly chart. This candle is still forming, by the way, so we can't really rely on this candle yet. We have to wait until Friday to know exactly what this candle is going to look like, but we can rely on the daily chart today because the market's closed. Oil K, very bullish. I mentioned yesterday that oil is more likely to move up today. It did, based on this candle. Check out my video from yesterday. PSX, Phillips 66, energy sector, oil and gas. This one's looking great too. Okay, I like this one on the daily. I like it on the weekly, up 4.31% today. Where might it find some resistance? If you look at the weekly chart, it's more likely to find resistance right at the high there from April 12th of 2024. That's where it's going to find resistance most likely. But it could just break right through it, that 174.08 level. How far are we from that level? We're about 2.37%. We're not that far away from it. So a lot of times what will happen is that there are people waiting here to take profits at that 174.08 because they're looking to see where that resistance, the next level of resistance is. And so the people that have been long this whole time, um, they might want to just take some profits. And you might see price stall at the 174.08. But in this environment with the war in Iran, obviously, we could certainly break through that 174.08 and see a continuation to the upside. You got VLO, Valero Energy Corporation, looking good on the weekly chart, up 6.48% today. Here's a daily chart, looking very bullish. It pulled back, found support right at the 9 period, the Tenkan-sen, and popped. XLE broke through the Tenkan-sen today, up 2.48%. That's the energy ETF. Here's the weekly chart. Now the weekly chart's been stalling around this area here. So, but again, things look more bullish for oil stocks than they do for traditional stocks. But so you have to be a little bit more cautious when you're picking other stocks outside of the oil space. Adobe in a downward channel. Okay, so this is where things start to like change course, or they start looking negative, which is why they don't have a blue flag. Okay, so the rest of these, like I said, are bearish looking, even the ones that were up today. So let's run through these very quickly. I'm not going to spend too much time because they're obviously bearish. So why do that? Adobe's in a downward trend? No. APO is in a downward trend, but finding support at the 200. No on that one too. It's under the cloud. Alibaba has been pulling back, finding support though at the cloud. We might see a bounce tomorrow, but on the this is a weekly chart you're looking at. Let's look at the daily. Okay, so it's stalled right at the Tengens, and I wouldn't be buying this. BX, Blackstone Inc., under the moving averages, under the cloud. Blackstone, stay out of that one. CDNS is under the cloud, showing a little bit of more strength here, Cadence Design Systems, but um, as you can see, the directional moving index is starting to become bearish right here. Let's look at CME Group, under the Kijunsen, under the Tengen-sen, down 0.98%. It's in the financial services sector, which hasn't been doing that well. CRM is under the cloud? No. Hold on, going too fast here. EEM, finding support the cloud, bouncing in here. Emerging markets on the daily chart, up 0.26%, but still under the Tenkan-sen and Kijun-sen. By the way, you may have noticed how different these moving averages look compared to other moving averages. Sometimes they actually flatten out, right? They become flat. And sometimes they merge, like right here, where the Tenkan-sen and the Kijun-sen are at the exact same level. Okay, and they flatten out. That's because instead of looking at the closing price, like most traditional moving averages, right, it's taking a look at the midpoint of each candle. And so by doing that, you're getting the absolute average of each candle, right? So it takes the high, it takes the low of the candle, divides it by 2, finds this midpoint, and then takes that information, right? And in this case, the last 9 periods and the last 26 periods just happen to be at this exact same level. The price there, if I hover here, on the left-hand side, there'll be a box that pops up. You'll see conversion and baseline, which is the American name for the Tenkan-sen and the Kijun-sen, and it's at 6110. Okay, do you see that under Ichimoku? So 6110 for the conversion, 6110 for the baseline. That's the next level of resistance. It's approximately, I don't know, around 3.7% away from where we currently are. All right, let's keep going. Actually, let me just take a quick look at the weekly chart on EEM. EEM, I'm not, I'm kind of liking this candle that's forming here this week. I'm really liking what I'm seeing here. Now, here's an interesting thing that occurred this week. Price actually pulled back a little bit. It actually gapped down and then immediately started getting bought up this week. So it came down to this prior level. See that high, the 56.31 level, and now it's been being bought up. So emerging markets actually looks like it wants to move up, but it still has some barriers. It's got the Tenkan-sen that it has to contend with. All right, FTAI, aviation, in between the two moving averages on the weekly chart. It does need to break back above. It's in the industrial sector, down 4.25%. Let's look at the daily chart. Yeah, it's not looking pretty here. As you can see, the Ichimoku's letting us know that the ADX, I'm sorry, the Chiku span or lagging line here is under the candle 26 periods ago, 26 days ago. Price is entering the cloud. That's bearish. Tenkan is under the Kijun. That's bearish. And look, down below, the directional movement index confirms it all. Okay? So stay out of FTAI for now. It's just my opinion. You can do what you want. GLW Corning Inc. pulling back. No on that one. Goldman Sachs under the cloud. No on that one. IBM under the cloud. Even though it's finding support here, no. IGV, no. Intel, more interesting here. We can do a little more further analysis on this one. So not all of the elements of the indicator are bullish yet, but we're seeing more strength here because price did yesterday broke above the cloud, stayed above it today. The cloud seems like the Singspin is moving up. Tenkan looks like it's moving up, but it has not crossed back above the Kijun yet. And the Chiku span is moving up, but it has not gotten above the candle yet. So it looks like we're moving in the right direction. If you look at the directional movement index as well, see the positive crossover there? But the momentum hasn't increased to the upside yet. Now that's the daily chart, mind you. So let's look at the weekly. Here's the weekly chart. Looks pretty bullish. By the end of this week, this candle may in fact break and close above the 9 period, or Tenkan. And if it does, I think Intel is going to look like a very interesting potential stock to. If you're, I'd be more bullish on this. Obviously, it was up 2.57% today. KRE under the moving averages on the weekly and under the cloud on the daily. So no, LRCX is inside the cloud, showing a little bit of strength here. We had a bullish engulfing pattern on Monday, and it moved up slightly, but all the indicators are still mostly bearish. Okay, except for the cloud it's been moving down here. We have a lower low right here. So, but we don't have a lower high yet, right? So if you go here, we've got what's called a megaphone pattern right there. See that slight uptrend right there? So we get that high is higher than the prior one. So that's why that trend line is moving up. And then you get this low here, and there's the other low. And so what we've got is a megaphone pattern, okay, which is mostly bearish in my opinion. Let's look at Oracle, which was up 9.16% today. They came out with earnings yesterday, and let's look at, like it actually spiked overnight after hours, and the price spiked, but the candle reveals the true nature of what's truly happening under the hood of what we're looking at here with Oracle. This is a bearish candle, and even though it was up 9.16%, that can fool you into thinking like this is the proper time to buy Oracle. I don't believe that's the case. Yes, the directional movement index is looking bullish, and this is primarily what I look for when I'm interested in a stock. Problem is, this is a bearish candle on the daily chart. We are still technically under the Ichimoku cloud, so we're still in a bearish territory here. Let me just check something. I'm kind of curious to see where the daily level is right there. Oh, isn't that interesting? So check this out, guys. This high right here. You see this candle? That's from February 10th, 2026. We haven't broken above that level. In fact, we pierced it. We got above that 165.39 level, but then we closed underneath it. It's more bearish, in my opinion, based on the candle itself. So I don't just use the Ichimoku. I do need to use other, um, you know, information, and the information from the candlesticks can tell you quite a bit. Let's look at the weekly chart. Okay, these last 3 weeks we've been bouncing a little bit above that 200, but again, we're still under the Tenkan. We're still under the cloud, right? So that's important. And if we look at, by the way, we can find out a little bit more about this particular day if we switch it over to a shorter time frame. Let's look at the 3 minute, and this is going to expose why this candle is bearish. Okay, so we're looking at a daily candle, but we switch it over to the 3 minute, and what we see here is, yeah, we had that big gap up. Price moved up to this level of 171.67, the high there, and from that high, it dropped 5.09%. Do you see that decline there? So that's why I'm more skeptical about Oracle at this point. I mean, obviously, not all the things are aligned at this point. All right, let's keep going. Palantir, under the cloud, under the 200. No on that one. XLF, financials, still declining. Under the moving averages, under the cloud. Very bearish. Very bearish. XLI looks more bullish. It's the industrial sector ETF, but still under the moving averages here, okay, on the daily. And if you look at the weekly chart, more bullish than financials, obviously. Look at the financials, XLF inside the cloud, XLI is above the cloud and just barely under the Tenkan. This has potential to actually pop right back above. And then XLK on the weekly chart, we're still under the moving averages here. Okay, we're above the cloud, but we're under the moving averages, and we had a negative crossover this week for the technology sector ETF, XLF, I'm sorry, XLK. And if you look at the directional movement index, that's also negative. And if we look at the daily chart, we're under the cloud. So this is not the proper time to be buying or to be jumping into this ETF. Now, I'm not suggesting that you should completely, you know, uh, discard and disregard all technology stocks, because guess what? There's going to be some really strong stocks within the technology sector itself, and that's what I look for. If I'm going to be adding a position, I'm looking for those very few rare gems that make sense, that are breaking above levels of resistance, and it makes sense to actually consider them. All right, let's look at the members' requests now. These are three stocks we'll take a look at. CGON, I'm sorry, OG, CG Oncology Inc. It's in the healthcare sector, biotech. All right, look at this, guys. On the weekly chart, very bullish trend. On the daily chart, very bullish trend. If we look at it on the weekly, once again, it broke through the cloud right here back on September 19th, 2025. It's moved up 76.15%. So it does seem to have negative profit margins. A lot of these biotech companies will have negative profit margins. The capitalization of this company is pretty large, actually, $5.1 billion. Look at that price of sales, 794.49. So this is more, you're taking a little bit of a leap of faith that this company is going to do well. I'm guessing that the member probably did his research and knows a little bit more. Let's just look at FinViz for a moment. We're going to type the ticker symbol up here in the search bar, CGON. There it is. Let's take a look at this company. Ooh, interesting. Okay, so look at these prior earnings announcements. Do you see how they're red here? Right? If I hover here and we look at that, that was back in May 13th, 2025. You see the revenue was negative, right? Surprise, they had a negative 72.38% surprise back then. Back here in August, it was a negative 100% surprise. Over here, it was actually a positive revenue. The first positive revenue surprise of it was about 2,704.71%. Okay, interesting. And then over here this is the most recent one, February 27th, positive revenue surprise of 405.83%. And look at all the green here in the EPS gap. So this is, again, one of the ways that you can kind of review a stock. You can look at the most recent earnings announcements. We can see the performance year to date. It's been up 55.73%. For the year, 12 months, it's up 145.86. The sales are increasing. That's good. That's very positive. It looks like they got a positive analyst rating from Wedbush that was initiated on December 11th, 2025. So sometimes, if it's a company that's not very well known, and they only have 142 employees, right? So you can't really make much of they're not, a lot of these analysts are not going to be reviewing it, but the most recent one was positive with a price target of $70, and we're at 64.66 right now. You can look at the news here, and scrolling down further, let's take a look at what they do. It's a clinical biopharmaceutical company which engages in the development and commercialization of bladder sparing therapeutic for patients afflicted with bladder cancer. It offers critostimogene, I'm not going to pronounce that right, critostimogene product initially in clinical development for the treatment of patients with non-muscle invasive bladder cancer. So And if you guys want to learn more about the company, you can also look at the most recent news up here, for example, and of course their statements, right? Okay, let me actually. I'm curious to see. Yeah, it looks like the net margin. So net margin wise, like it's improving. If you look at that, the histogram here, that's actually improving. So that's very bullish. All right, so that's how you can use FinViz to do a little bit more further analysis, depending on what you want to learn about. Okay, let's look at the next stock. So I like CGON. I like it. It looks great on the technicals. I like the fundamentals too, actually, except for that. Wish it was profitable at this time. It's not yet, but it's moving in that direction. COP, ConocoPhillips, oil and gas looks good on the weekly overall. If you look at the cloud turned bullish here, we got above the 200 back on February 6, 2026, but we've got a few negative reversal candles here. It is in the correct energy sector. It was up on the daily chart today, up 2.51%. In fact, it gave us a nice little bullish signal here because it got back above the Tenkan after a brief pullback. And that's normal. Like if if price is always going to be pulling back and then eventually it's going to break and continue to move up. And I think that's what we're seeing right here. So I think it has a higher probability of moving up tomorrow, this week, basically based on the daily chart we're seeing right here. So COP. Let's look at UMAC. On the weekly chart first. Here it is. We've got a bullish cloud. Price is above the moving averages. Chico span is above price on the weekly. On the daily chart, it seems to be stalling around this high here of $20.16. Now, this is a company called Unusual Machines Inc. It's in the technology sector. But again, like I said earlier, you might find a few gems within a sector that's not favorable right now, like the technology sector. Let's do a little more research though on UMAC because I'm not very familiar with Unusual Machines Inc. Okay, so let's take a look at InfinViz UMAC. There it is. Okay, most the most recent earnings announcement, we had a positive revenue surprise of 36.43%, but it did not do so well here with the EPS and EPS gap. What about how it's performed? It's year to date, it's up 55.73%. For the year, it's up 248%. Average volume is about 3.47 million shares. That's a good thing. Um, Sales have been increasing significantly from 2024 into 2025. You can see here doubled. Um, let's see. Strong Q4 revenue agrees to merge with Mistral. Ooh, so we had a big jump today. Let's see. I'll just also reiterate its full year 2026 revenue guidance of 107 million to 180 million. Let me see. I just want to check out something here. So the sales, how many employees are here? Just 18? Oof, man. I'm always really skeptical about companies that have such a low number of employees because, like, you know, it's just not established at this point, you know? Um, but you can't deny the technicals here look very bullish. All right. So what was it that I wanted to look at? Let me check out the profit margins. I'm just kind of curious about that. Well, the net margins are actually declining from the prior from September 30th, 2025. You can see here December 31st, 2025, it was down 216. And the other thing I wanted to check on, profit margins negative 171.38%. Not a company that I personally would buy, but I like the technicals. If it's something that maybe you have some information and you like the company, it seems to be doing pretty well here. It seems to be doing pretty good overall. Guys, that is going to do it for this video. We just finished all the stocks, all the ETFs that they discussed on the show too. If you want to support the channel for free, doesn't cost you anything to do this, by the way. You can hit the subscribe button. Subscribe for free, hit the notification bell, hit the like button, Now there's a new thing called Hype. You can hype for free channels that you like. Every Monday they give you new hypes. You might as well use them, and it helps to actually push the channel out to more people. So it hypes it up. Trying to reach 29,000 subscribers. Hard to believe that we're almost there. We're 28,400 right now. Thanks for watching. I will catch you all in the next video.